Well, hi there, everyone. Welcome to Chart This with Dave Keller. Happy Wednesday, May 28th. I'm your host, Dave Keller, coming to you from a beautifully clear and actually quite warm Redmond, Washington. We've got highs in the low 80s today, so that's fun. But overall, enjoying the good weather, enjoying the positive news post market close with Nvidia accelerating to the upside in the after hours on quite strong earnings. I mean, honestly, I'm not super surprised, only because Nvidia is one of those companies with the growth in AI, with the incredible expectations. It's managed to match them so beautifully. However, the major averages, a particularly weak day going into this big post-close earnings report. We'll talk about the S&P 500. We'll talk about the breadth conditions, the trade in Nvidia, and everything setting up for today's earnings announcement. Salesforce, also another big one, reporting, and their call starting as we go live here today. We'll look at those charts in particular and a bunch of other things as well. Sound good to you? It sounds good to me, and I appreciate so much of you, those of you tuning in live on YouTube, Facebook, LinkedIn, and X. Appreciate you guys checking in as we go on. Any questions as we go through the markets, as we go through the heat map, as we go through the charts, just pop them in the comments section wherever you're watching this. I'll grab a couple questions before the end of the day and before the end of the episode. Anything we don't get to, we will put in the mailbag. We're planning an all mailbag episode on Friday. We'd love to answer one of your questions on the show. Looking at the S&P, I mean, yesterday, a pretty strong upward move. Today, kind of the opposite, higher open, weaker close. The S&P finished toward the lows of the day, suggesting muted expectations going into the post close earnings reports from Nvidia and Salesforce, as well as some others. 58.88 is where we're at, just slightly above there. That's 0.6% lower. The Dow, the NASDAQ, all about identical in terms of their percentage moves today. Mid caps and small caps down a little more, so about double the down move for some mid caps here. The mid cap S&P 400 was down 1.2%, almost exactly the same percentage-wise for the small cap space. So that's been an environment, I think, has been the story, certainly for most of 2025, certainly off the April lows, that we've seen large and mega caps doing better than mid caps and small caps. Kind of a tired theme. I feel like we've been reminding everyone about that for a while now. No real change there. And, to be honest with you, if we do have a growth-led rally, which this certainly – you have industrials actually doing quite well, but the average chart that's sort of leading the way seems to be a growthy name right about now. Mid caps and small caps are probably going to underperform because they're less weighted into the growthy stuff, certainly less weighted into the Nvidias of the world. All right, we got the VIX pushing higher, about a third of a VIX point. We're still below 20. We are just above 19.3, and so we are technically still in a low volatility environment. A spike above 20 would be a red flag of sorts that I would be looking for. Not today. All right, looking at some other asset classes here, the bond market's continuing to sell off a bit through the course of the afternoon after rallying. Sorry, that's not true. I was looking at yields there. Bonds sold off out of the open and rallied into the afternoon. That means rates generally moving higher today. The 10-year yield finished today around 4.48. The long bond yield just below 5%. And the 5-year yield, we'll call it, 4.06 or so. So bonds rolling over today after, rallying yesterday. Will we see more of a rotation away from bonds and back into stocks? The news like we saw from Nvidia certainly will probably inject some adrenaline into the system tomorrow. But we'll see. I mean, it's all about what happens. I mean, these are after hours reactions that we're seeing. Tomorrow, plenty of headline risk remains. We'll see how things net out. The dollar index about a third of a percent higher. Stronger dollar, stronger crude oil, with potential kind of double bottoming patterns on both of those charts are things that stand out to me. Precious metals rotating lower today. Gold actually finished strong yesterday, finished a little more weak today, sort of whimpered into the close. Not by much, so about 0.25% down for the gold ETF, the GLD. The silver ETF down 0.8%. Copper prices down. Crude oil was up. But other than that, most of the commodity space not particularly good. Pretty big Bitcoin conference happening in Las Vegas this week, I'm told. I'm not a big go to crypto conferences kind of person. I think this is Bitcoin 2025, I believe. And overall, not a great day for Bitcoin. Although, again, we are at or near all-time highs. When we go to the left, you can see yesterday we were above 110,000. We're currently down just above 107,000. It's down about 1.5%. Sort of stabilized through much of the day, but then when the equity session opens, you can see we sort of rolled over pretty aggressively. So all 10 of the top coins tracked on stock charts are in the red. I do own positions in Bitcoin and Ethereum. Not planning to change that anytime soon. All right, looking at the 11 sector ETFs, you can see it wasn't great. You have REITs that were basically a nothing burger, unchanged from yesterday's close. Communication services also basically flat, 2 pennies below yesterday's close. Technology down 0.4%. So this wasn't a great day in terms of sector breadth. Pretty much everything flat to down quite a bit. On the downside, you have utilities down 1.4%, about the same for materials, and then energy down 1.33%. Crude oil, it looks like a double bottoming pattern, but if that's true, it hasn't improved enough that the energy sector starts to look remarkably strong. I mean, from a technical perspective, arguably still one of the weakest, if not the weakest, of the charts. If I throw the 11 S&P sector charts, energy is going to be pretty far down the list of good charts, and arguably at the bottom right about now, matching things like healthcare and others that have been struggling for quite some time. The breadth not great today. And again, you're seeing big swings in advanced decline data, right? Earlier this week, and maybe the end of last week, it's all sort of glossing together coming out of the long holiday weekend. The cobwebs are still there a little bit. But we had a 90% up day. I feel like that was end of last week, maybe on Friday. But today we've got an 80% down to 84% of the S&P members were down today. About the same for mid caps and small caps. 73% of the New York Composite Index down versus up, so about a 3-to-1 ratio of decliners versus advancers. The NASDAQ composite with the best breadth, but it's still negative, right? 2-to-1 ratio of down versus up. So we're seeing some, again, kind of mixed breadth readings, to be honest with you. I think we're seeing some heavy rotation. We'll highlight the McClellan oscillator really fluctuating around the zero level this week. Really started last week. Days like today, basically most things are going down. And again, but the reality is the S&P isn't cratering. It's not like you get this big sell-off. I was on a Twitter Spaces or an X Spaces or whatever we're calling them these days earlier today with Michael Guyot of the Lead Lag Report, who's sponsored by Granite Shares. And we talked about kind of a bunch of random things. It was sort of like let's all chat about the markets and trading and technical analysis. Found it quite enjoyable. But one of the things we talked about was basically the movements here recently, particularly in Nvidia, in the NASDAQ. And I equated it to a power on stall. When we bring up the chart of Nvidia, I think perfect time to talk about that sort of analogy. And then we'll look at the aftermarket, after hours trading, see how things are playing out there. All right, the Magnificent Seven and friends. You have Broadcom up 1.6%, Meta and Apple slightly above zero. On the downside, you have Tesla down 1.7%, Microsoft down 0.7%. I mean, not bad, right? I mean, Broadcom actually surging going into NVIDIA's earnings. NVIDIA was down 0.5%. Broadcom, which actually usually, moves in line with NVIDIA, up a lot more. Maybe there's a message there. On the industry list, can't help but notice that gold miners and mining stocks were 2 of the top 5 performing groups. Generally speaking, quiet day, weaker breadth. I mean, everyone's sort of holding the breath into NVIDIA's earnings. It was a pretty strong earnings release. Looks like the markets certainly looks like NVIDIA is surging after hours. We'll see if that is enough to propel the S&P and the NASDAQ out of their little maybe flag pennant kind of patterns. We'll see what we want to label it as we get to the charts here in a moment. All right, continuing on here, we'll get to the heat map. As a reminder, I can't see questions you have coming out. And please drop them wherever you're listening to the live stream if you are watching us live. If you're watching this on a replay, always welcome your questions in the comments section of our YouTube channel. We'll be preparing an all mailbag episode on Friday. So enjoy answering your questions that come in through the course of the week. And I would love to answer one of yours on the show. So keep them coming, please. All right, looking at the heat map here at a high level, not a great day. You can see the average color is kind of neutral. You can see some big down moves really across a number of different sectors, and things that jump out to me as we talk about stocks kind of moving down. Certainly in the technology sector, which is in the upper left, some random things really struggling. Cadence is one coming off of a basically a test of the peak. I mean, charts like this are just such a great reminder as to why technical analysis matters, in my opinion, right? I mean, I don't think it's a coincidence that a stock like CDNS hits resistance right around 320 to 325. Let's see, 1, 2, 3, 4, 5, 6, 7 times in the last year and a half. So we've continued to rotate back up to that same level. So when you see this gap, and you see the acceleration, I'm immediately looking to the left on the chart. And when we talk about, okay, listen, a lot of overhead resistance, if you ever hear me, utter that phrase, the chart of CDNS is kind of what I have in the back of my mind. A lot of overhead resistance, or what we call a supply zone, is a level where we've seen selling before. And sometime that takes some like classic reversal patterns. This is a bearish engulfing pattern that you see at the June 2024 peak. Maybe it's just a new high, a new swing high that immediately is followed by a downtick the next day. Whether it's an island reversal like you see here with a gap higher, couple days of trading, and then a gap back lower. All of those sort of reinforce the fact that this is about the time where uptrends have stalled out. And there could be a number of reasons why that has played out. But as Tom McClellan, when I've talked to him many times about this, he is concerned with predictability or repeatability, right? I mean, in his opinion, seeing a pattern that continues to repeat, we can maybe argue down the road, we'll know why exactly that level had meaning and why exactly there's an exhaustion of buyers right around the same point. I've learned to trust the charts. And if the charts tell you this is where the stock tends to peak, I'm pretty comfortable expecting some sort of pullback from those levels. And today, obviously down over 10%. On a big downside move, one of the worst performers in the S&P, but certainly you're seeing the resistance play out yet again. Good reminder to set alerts to review charts approaching key resistance and just be careful riding stocks right into that resistance if there's a lot of evidence of previous pullbacks. Within the consumer discretionary sector, I'm noting some of the gambling names. That's Caesars. Rotating lower. This is after making a new swing high last week, sort of rotating off of those levels. Home builders certainly getting absolutely crushed here. Lennar, DR, Horton, Pulte, NVR. None of these are particularly good charts. I think we highlighted the ITB yesterday. I mean, this is an right? I mean, Jesse Livermore, I just blanked on Livermore's name. Sorry about that. Jesse Livermore famously said, there's time to go long, time to go short, time to go fishing. And I think on the chart of NVR over the last couple of years, you can, if you look, you can find clear examples of each of those phases, right? Livermore's time to go long phase, I would say, is when you have a basing pattern and when you have a breakout, when you have an uptrend, when you're above two upward sloping moving averages. This is when I think that we're in an accumulation phase. You have signs that investors are buying the dips. That's the time when I more want to be playing the long side and just assuming that the uptrend is in play. You have distribution phases, or as Livermore would say, time to go short. This is when you have bearish divergences at major peaks and start to rotate lower. It's when you break below the 50-day moving average and the momentum starts to weaken. It's when you start to underperform. Certainly when you break below the 200-day and have a failed attempt to regain it, I think that's a clear distribution phase. You want to get out of the way or be playing more of the short side. Then you have this third period, right, which is more of a sideways trend, more of a sit on your hands period, as Livermore would say, time to go fishing, right? And that's when you have a pretty consistent resistance and support. You can kind of draw a rectangle around the price action that captures most of the movement. And I think that's what, a chart like NVR has been in. It's not been a particularly horrible chart, right? It's not breaking down. It's not in a confirmed downtrend, but it's not going up in a period when so many stocks are. And so remember, when you own a stock like NVR through this period, it's not that you're losing money on an absolute basis, that you're losing the opportunity to own something else that is doing much better, right? This is why relative strength is such a great feature on charts that I look at, because it shows you whether or not owning a stock that's sideways is helping your portfolio or not. In this case, it's absolutely killing you, because you're losing out on the opportunity to own other things that are in a better, more constructive pattern. So home builders continue to be an underwhelming place to be. If rates start to drip lower, if you see bonds start to rally, that's going to help home builders. Today, we saw the opposite. We saw bonds sell off. We saw rates pop up. And there tends to be an inverse relationship between interest rates and home builders, because your mortgages are based off of the, basically the 10-year Treasury yield. Oh, that was a deeper dive than I expected to do on the chart of NVR, but I think it's a great example of that. Another thing that I'm noticing, and I'm remembering this, I'm reminded of this because one of my a couple of my premium members have asked about scanning and designing some models based on more quantitative methodologies. And one of them asked a question, about a model they were working up, or a basically a scanning approach, a way to identify new ideas. And they look for stocks with a low dividend yield below 3%. And I sort of, called them out on it a little bit and just, asked, that particular factor, the problem with having that in there, what that's going to do is kind of aim you away from value and into growth generally, right? Because growth stocks are the ones that tend to not pay dividends on average. But you're going to be avoiding some really good value plays and certainly defensive plays. And that screen is going to work really well as long as the market still goes up. But if you start to see deterioration, those areas of the market, those higher yielding defensive plays, if rates start to go down and a 4% dividend yield is all of a sudden a really good opportunity to gain some income relative to bonds, that's where you're going to miss out on opportunity. So I'm not as much of a fan of having that sort of factor on there. I'd much rather keep an open mind to higher yielding stocks that actually do start to do well. And when you see things like consumer staple stocks pop up in a positive scan, that tells you something about the market conditions, but also helps you find some opportunities. For what it's worth, I would say the defensive sector is not doing particularly well this week. You can see utilities, consumer staples, all more red than not. Real estate, maybe the best of this group, with some green peppered in there. But overall, I would say the defensive sector's sort of on their heels right about now. That's it. And again, going into Nvidia's earnings, besides Broadcom and Oracle that are green today, most of the mega cap growth stocks are down today, right? Meta was up slightly, just kind of not down. But I mean, overall, that's a theme certainly to watch going into the remainder of this week. Post earnings, we'll see what sort of pop we get from Nvidia and elsewhere. All right, I've made kind of a mockery of all of these tabs. Let's go to the charts and focus on what we can find here. The daily chart of the S&P 500, similar to what we'll see with Nvidia. I'll save the discussion of a power on stall, although I think it's a pretty decent analogy coming up here. I meant to bring up the SPY, by the way, because the S&P is showing a bit of a candle pattern, a dark cloud cover pattern, I would call it. But I'm not sure if we're getting that same pattern on the SPY. I mean, not as much, right? But a dark cloud cover is where you have an up candle and a down candle, and the second day opens higher but closes not below the previous day's open. That's called a dark cloud cover. Yeah, it's kind of the same thing here. If we go to, let's see, just a little bit more. So a bearish engulfing pattern would be an up day followed by a down day, right? We have a higher open and a lower close. I'll zoom in a little bit so you can see. So a bearish engulfing pattern would be an up candle, a down candle. Day two has a higher open and a lower close. So the range expands up day then down day. This is where the candle doesn't get, I mean, it's almost just right below halfway down through the first day's candle. So it's not a bearish engulfing pattern. It's called a dark cloud cover. It's not a perfect one. I don't know if I want to make that the most important thing I tell you today, but something I'm noting is we had a down day. We got just below halfway through yesterday's open close range. So that's technically a bearish candle pattern. So we'll see. Again, the story of the S&P is bouncing off of our this range that we've talked about from around 5720, 5780. That's the gap range from earlier in May. The rally off the April low is pretty significant. These gaps along the way, I think, are pretty important. I think this most recent gap is an important one to follow. The range here is what I'm highlighting with this red shaded area. I think anything above that red shaded area is pretty constructive. I think if we pull back into that red shaded area, we would expect support, as we saw on Friday with a trade down to the 200-day and a close back above. And that also means if we get through that range to the downside, I think this market takes most likely a pretty violent and negative turn. That's a big if. That's assuming we don't hold that level of support. But it's certainly the way that I'm thinking of it. I think this market is innocent until proven guilty. Proven guilty would basically be breaking below that shaded area. So what I'm thinking is kind of thinking like in a stoplight sort of form. Anything above 57.50 and change, I think is fairly constructive. Anything below that, but still above 5,500, I would consider more neutral. Yellow light, that's where I'd probably start lightening up on more risky positions that I may have added here. And anything below 5,500, I think is pretty dangerous, and I would personally be out of the way and either playing the short side or just out of the way of things, because there's an increased likelihood that we go aggressively lower. Now, the breadth conditions, to be honest with you, I would argue at this point are kind of neutral, depending on what you look at. Things have actually, most things have improved from early April. That is, I think, undeniable. But the question is, does the breadth really look constructive here? And I would say it depends on what you're looking at. Some of the short-term breadth indicators that I follow, like the percent of stocks above their 50-day moving average, got above 75%, which is kind of our overbought threshold, has now come back below in the last week and a half. That suggests that we've had a really nice rally, and then we're probably in a bit of a pullback after that rally up. The long-term breadth, which is looking at the percent of stocks above their 200-day moving average for the last week, has been almost dead even at a coin flip of 50%. So if you pick a random member of the S&P 500, coin flip as to whether or not it's above its 200-day moving average. That's not a bullish, sort of long-term structure. That's more of a neutral long-term structure. That tells you we were pretty bearishly positioned with so many things below their 200-day. But now we've rallied back to neutral. We're not bullish. We're not in the range we were through much of 2024 when it's like 60, 70, 80% of the S&P are above their 200-day. That is a market firing on all cylinders with a clear uptrend phase. The indicators are not telling me that right about now. It's more neutral. We also can see that kind of neutral vibe by the fact that the McClellan oscillator has been fluctuating above and below zero. This is not updated for today's close. This is as of yesterday's close. Had been below zero for a couple sessions. As of yesterday's close, above the zero line. Once it's updated for today, I would be pretty surprised if it was not back below the zero level, given the advanced decline data I'm reviewing. This indicator in particular, the McClellan oscillator, is based on the trend, or really the momentum in the advanced decline data from the New York Stock Exchange. My guess would be it actually rotates back below zero, which tells you it's still, sort of negative short-term breadth by my reading. Now, friend to the show and someone who's been on my podcast before, Frank Capillari of Cap Thesis. I followed Frank's work for years when he was back at Instinet, and think very highly of his work. He's a very fellow CNBC contributor. We write together for the Chart Investing Pro portion of the website. He was highlighting how the breadth for the S&P 500 has been pretty good, and I can't disagree with that. He was highlighting this point here, that the cumulative advanced decline line for the S&P 500 broke out at really the beginning of May, and that's true. I would say the counterpoint to that argument, where I would probably disagree with Frank a little bit, is the fact that the other advanced decline data is not as good. We're highlighting the most constructive, which granted is in the biggest names. This is the large mega cap U.S. Trade, strong, 100%. But is the breadth in the other areas of the market, which I would argue is much more important, is that validating the uptrend? And here the answer is no, right? So none of the other advanced decline lines have made a new high yet. They're still actually below their highs from last Thanksgiving. So I would say this market has had an incredible run, but still the breadth data is not overwhelmingly bullish at this point. What else can we go? Let's keep going to this one. So let's finish off talking about a couple, a sector chart. We'll look at some individual names, and I see a couple good questions I'd love to take here before we wrap the show. This is a chart that I took and adapted from my Mindful Investor live chart list. That's not what I call it anymore. The Market Misbehavior live chart list, we call it. You can find that list on stock charts at marketmisbehavior.com/charts. It's free to access. If you're a stock charts member, you can save any of the charts on that list to your own login, do whatever you want with them. If you're not a stock charts member, you can still see them through that hyperlink, marketmisbehavior.com/charts. I have a series of charts that look at the relative performance of the 11 S&P sectors. And this one in particular is an adaptation of that. I just want to focus on the last 1 month. So market bottomed in early April. If you sort of go from late April to now late May, which three sectors have done the best? Technology is your top performer, up over 11% in the last 1 month. Industrial is number 2, up over 10% in the last month. Consumer discretionary in third place, just under 9%. And that's compared to the S&P 500, which is up just under 7% for the last month. Now, what's funny is if you look after consumer discretionary, none of the other relative performance charts look pretty good. So this is the relative ratios that I'm charting. So this is a ratio of technology versus the SPY. So if the line is going up, that means for that period, the sector is outperforming. If the line's sloping downwards, it's underperforming. And if it goes sideways, it's a market performance, moving in line with the S&P. So generally, we would look for sectors and stocks and ETFs where the relative strength line is trending upwards, because that means I'm outperforming the S&P 500 or a passive benchmark. These are the only three relative performance lines that look good at this point. The defensive sectors like utilities, real estate, consumer staples, kind of trending downwards. You really haven't seen an improvement in those areas, given the strength in the markets. The other value sectors like energy, like materials, not as strong. Industrials is clearly the outlier. And communication services, I believe, is fourth place, but it's not as good as these other two. So these are the three sectors showing strong relative performance really over the last month. The rest are either in line with the market or underperforming. So to do well in this market, besides just owning the S&P and the Nasdaq, focusing on these sectors has proven to be very, very good. And these are the areas of the market. Certainly technology and industrials have been two areas we've been focusing on with in technology. Things like semiconductors starting to improve. Of course, Nvidia's earnings could be the next big catalyst there. In the industrial sector has actually been fantastic year to date. I mean, the relative performance has been consistently strong. And you have defense stocks doing quite well, but it's not just defense, it's other areas of the market, infrastructure plays, et cetera. So, when you're thinking with sort of top-down market in decent shape, which sectors are performing well, these are the three that stand out to me. This is where I would be focusing my attention to try to find top performing names. All right, as we've talked through the chart of Nvidia, what we've talked about is the fact that this is generally innocent until proven guilty. A couple reasons for that. We pushed above the 200-day moving average and held it. As long as that keeps playing out, I think that's good. We're above trend line support. That's a trend line that we've drawn on the chart recently just to show the general pace of this trend line, which means if Nvidia breaks below the trend line, breaks below the 200-day, I think this chart takes on a very different look. But for now, generally in an uptrend position. Yesterday was interesting, or today, we closed at the lows of the day. We closed around 134.80 on Nvidia. Here's what's happened after hours. So pretty much right after the market closed, we started to rally. And just so we're clear, this is Nvidia day session or pit session until 4 p.m. Eastern. This is the after hours and live trading showing the after hours session. So Nvidia rallied in the aftermarket up to just above 143, it looks like, which would put it, right around here, which is basically retesting the February peak. And from there, we're starting to pull back a little bit. We're currently trading just around 140. So we're kind of right around this point. So during the after hours, we're kind of up in this range. So basically retesting. We've round tripped up to that February peak. Now, the chart of Nvidia, I would argue, the analogy I would use is a power on stall. And I think I shared this yesterday. And if I did, I apologize. Indulge me for 30 seconds and I'll explain what this means. If you've ever tried to fly an airplane, once you kind of get the basics, you start to do emergency training, right? You're basically just trying to make sure you don't crash the plane or put the plane in a position where something bad is a likely outcome. And one of the classic things you need to practice are stalls. And I will tell you, having gone through some flight training, my palms are sweating a little bit just explaining what stalls are, because it was, for me, the most challenging part of of learning to fly a Cessna, because stalls are where you basically make the plane unable to fly. A stall is not like how you think of an engine stalling, where like the engine cuts out. A stall is basically where you put the plane in a position where it can't fly. A plane flies because a wing, the airflow going into the wing creates lift. That's the downward pressure that causes the plane to go up, because the wings generate lift. And that's the most important thing you want to do. It's all based on what's called the angle of attack, which means you make sure the wing is aimed into the wind. And if you mess with that angle and make it too steep, literally the wing just doesn't create lift anymore. And what happens is the plane just goes down. That happens most often when you're coming into land. That's called a power off stall. You have the throttle out and you're just trying to coast in. And if you have the angle too high, you go down very quickly, and near the ground, that can be a problem. This chart looks like a power on stall. It looks like the flight path where you take off, but all of a sudden you pull back too much. You put it too high of an angle and the plane stalls. And on a power on stall, you usually don't lose a ton of altitude. You just kind of stall out. You just kind of go sideways, right? It's like the plane just doesn't want to go up anymore. And if you recover correctly, if you ease off a little bit, the plane can resume its normal upturn. I think that's the bullish case here on Nvidia. And you hope that a positive earnings release, which it sounds like we got, propels the chart of Nvidia out of that stall and breaks above 137, 138, continues upwards. And if so, I think that is a very bullish chart. If, however, you don't recover from the stall correctly and the nose dips down, that's where we start to fail. And for me, that sign of failure would be breaking below the trend line, breaking below the 200-day. That's around 126.50 right about now. So I think the chart of Nvidia overall constructive. I think if we do get the positive reaction, it seems likely going into tomorrow. Can we get out of this range? And I think this is my sort of general stop below the 200-day. If we break out, my new stop is that breakout level. I think that would be the level to watch to see if we can hold that and gain altitude above those levels. There we go. So that's how you successfully execute a power on stall. I hope that that made sense to you. And if not, we'll move on. Shout out to my daughter, by the way. She's been threatening to add a comment during the live broadcast for months. I actually see it there. Hi, honey. Yes, maybe we can go on a hike after the show. She's been threatening to do that for a while. Finally pulled it off. Well done, honey. All right, let's look at a couple more charts here and then we'll be done. Actually, I think this is the last one. Salesforce.com. Earnings today after the close. Let's look at the chart of CRM and see what's actually happening here. So CRM spiked after the close, but then rotated right back down. And to be honest with you, we're not too far off of today's close. We're around 277 and change. So we had an initial spike higher after the equity close in the after-hour session. But as earnings come out, sort of rotated lower. It looks like the earnings call is probably wrapping or is in progress at the moment. But I would say what's interesting about the chart of CRM, Nvidia with that power on stall kind of look, CRM is more looking like an inverted head and shoulders pattern. Right. And probably you can see it here. You have the low. It's almost a double head here, but you have the left shoulder and the right shoulder. The way that you trade a pattern like this, or the way that you interpret a pattern like this, is you have to remember it is a potential head and shoulders bottom until you break what's called the neckline. Right. So what I'm doing is basically drawing a trend line connecting these two swing highs. From here's the head, the left shoulder, the right shoulder. Here's the the interim swing high between the head and the two shoulders. You draw a trend line connecting those two points. That's the neckline, which means this is a really bullish chart if and only if it breaks above the neckline. You can't call it a head and shoulders pattern until the neckline is broken, which means Salesforce actually has to get above 295, clear the 200-day moving average. Also get above like 300 to clear this neckline. If that happens, Salesforce is a really bullish chart. If not, it's not a head and shoulders bottoming pattern. And I would say that 50-day moving average, which was basically yesterday's low, is the level I'd be watching. I would be watching there. Pretty interesting setup. For me, I would be patiently waiting for a break above the neckline. That's where I'm setting an alert. I'm actually jotting it down, a reminder to do that. But until and unless that happens, I would say Salesforce not a great chart yet. All right, let's take a couple questions or two, and we'll be done. 3P investors, the cash flowing into the USA or flowing out, net positive or net negative as of today. So yeah, I mean, there's certainly, I mean, I would say the biggest question mark and the biggest open question on these markets is the tariff potential, and really the headline risk in these markets. To be honest with you, we are one headline away from the market dropping. We are one headline away from the market surging, and that's what we saw with news over the weekend about delaying tariffs with Europe. These headlines can cause dramatic changes in investor sentiment, as we've seen here over the last couple months. I would say, I mean, if you ask me, what's the way to track that sentiment in particular of the dollar, right? Because if non-U.S. investors are trying to buy U.S. assets, they have to convert to dollars first, right? And so I think watching this surge in the dollar this week has been probably one of the more encouraging signs that I've seen. The S&P breaking above the 200-day, that's not bad. The S&P holding gap support, that's pretty good. But the surge in the dollar and improvement in the dollar, I would say would be the most encouraging thing, because the dollar was weakening aggressively from mid-January to mid-April. We then had a big pop higher going into mid-May as equities were rallying. As equities have stalled out, we've seen the dollar rotate lower. I would argue the bull case for stocks here, certainly for the S&P, most likely involves a rally in the dollar. Here's the problem: is non-U.S. markets have actually looked remarkably good, right? So here's the VEU, which is all world ex-U.S. It's sort of like global stocks outside of the U.S. Made new all-time highs yesterday, gapped down a little bit today, but overall, this is what non-U.S. markets, and again, totally generalizing, this is the kind of strength they're getting in non-U.S. markets. The S&P and the NASDAQ are not making new all-time highs in May 2025. Non-U.S. markets are generally doing that, right? So here's EFA, EFA, which is global developed market. Here's EM, EEM, which is China and other developing Asia, Latin America, Europe. At or near new all-time highs. The S&P and the NASDAQ are not at or near new all-time highs right now. So to get that rotation back, where you have investors that are now have found strength elsewhere, rotating into the U.S. To push the market higher, I think the strength in the dollar could be one of the most important things to watch for. Let's see. JB, thanks for watching on YouTube. As a long-term investor trying to apply all my Keller learnings, I appreciate you doing it. WMB Williams seems to check the technical analysis boxes. Thoughts? Let's take a look. So Williams, if you are unfamiliar, is a pipeline company. It's in the energy sector. I'm immediately thinking of the podcast interview that I did where we talked all about energy. And I went into that interview expecting to talk about crude oil. We talked very little about crude oil and ended up talking about other things. This is with Rob Thummels back on April 23rd. You can find that podcast interview on my YouTube channel. Rob was awesome, really knowledgeable money manager focusing on the energy space. And we ended up talking about other things. It wasn't about, oil producers. It wasn't about integrated oil, although we did talk about those things. It was more about Williams types of companies. It was what we call energy infrastructure, pipelines, natural gas. Those are the areas of the energy sector that have done remarkably well. So energy generally does not look great because crude oil prices have been weak, but energy infrastructure, which I would say Williams is part of that story, looks a lot better, right? And you can see that we've actually been consolidating on the chart of WMB. So I would say, whoops, hold on. I meant to do the unadjusted version just to take a look. Yeah, pretty similar here. So here's the chart of WMB. And if you look for the last 6 months, right? Strong uptrend going into November of last year. And then we stabilized, right? So this is a stock going sideways, but with a decent dividend yield. And I think that's a big part of the story here. Pipeline companies tend to be good dividend payers, tend to be consistent income producers, right? If you look at their general payout. So 3.3% isn't bad here. From a technical perspective, I would say the gap higher is good. I would love to see it clear this range and get out of here, which means for me, breaking above 62, getting to new highs would be pretty meaningful. This is an accumulation phase where buyers are outnumbering sellers. This is a consolidation phase or an equilibrium where buyers and sellers are in agreement. We're just kind of rotating around that level. Breaking out of that level, breaking out of that range is what we call a big base breakout. That I think would be a very bullish development in a compelling area of the energy space, energy infrastructure. on a name with a decent dividend yield. And if you combine that with a price breakout, pretty awesome. I'll set an alert for that one as well. I'll let you know if that triggers and how we can interpret that potential breakout after. But thanks so much for asking about Williams. Folks, that'll do it for today. Thanks so much for joining me here on Chart This with Dave Keller. I appreciate you so much doing so. As a reminder, keep the questions coming. You can pop them in on our YouTube channel anytime, and we'll do an all mailbag episode on Friday. In the meantime, enjoy the great weather if you're here in the Seattle area. All the best, and remember, it's always a good time to own good charts. Have a good night.